up, everybody? How's it going? I am live here with a very special guest. You might have seen him recently making the rounds in the streaming community. You might have seen him on Twitter uncovering all of the secret nuances of Hex that we don't really get to talk about. Or you might have seen him on the big screen. It's on the big screen itself in the recent Highest of Stakes showing. I have today the professor at DePaul University, has a PhD in finance and economics, and even was a employee at the Federal Reserve himself. I'm very excited to have this conversation with Dr. Lamont Black. How you doing, Doctor?
Doing great. Good to be here, CryptoSloth.
Yeah, thanks for coming on, man. I really appreciate your time, both with me, but also with the community, man. I'm sure it's been interesting for you to be seeing yourself on the big screen, but I'm sure it's also been interesting to kind of be thrust into the spotlight within this really niche community, especially as the quote unquote skeptic of the movie.
Yeah, it's been fun. I'm really so grateful that the community has been open to my questions and me kind of poking around. It really, I think it says a lot that people are open to these conversations. So I'm enjoying it.
Yeah, I can tell you, I've really enjoyed your interaction with the community as well. One thing, at least for me, for someone who's kind of gone down the hex rabbit hole, it's really interesting to watch people kind of go down it themselves and see the different avenues that they take and the different ways they get to finding what I'll call the value proposition of hex generally, and the different angles they attack it from. And I always learn something new when somebody publicly kind of shares their journey through the system, whether or not they're pro or anti against it. Just publicly sharing your thoughts. I appreciate that.
Yeah, and that's one of my big questions in the movie of what does it do? Why does this thing have any value? Is it a Ponzi scheme? And so, I view these last couple of weeks as just a continuation of that journey, trying to kind of figure this stuff out.
Yeah, absolutely. Well, I think that's probably a good place for us to start. Tell us a little bit about where you started. How did you even get involved with the movie in the first place, and did you even know about Hex when you first started the filming process?
Yeah, so the way I got involved was through my colleague Kelly Richmond Pope, who's also in the movie. So Kelly is much more well known than I am. She's a very public figure in fraud and forensic accounting. She has her own book now, Fool Me Once, and she also has her own documentary. It's called All the Queen's Horses. So she's kind of been out there talking about fraud for a long time, and the directors found her and approached her about being in the film. And then she said, well, I've got this guy I work with, Lamont. He's kind of the crypto guy. And so she reached out to me and said, hey, have you ever heard of Hex? And I hadn't. I spent quite a bit of time thinking about Bitcoin and Ethereum and some of the other altcoins, but totally new to me. And I tell people, when I first looked it up, it was just whoa, this is crazy. And you hear anything about Richard, and it's just it's even crazier. So yeah, I had a pretty negative reaction when I first heard about it. That scene in the movie where she and I are just talking, sitting across the table, that was the first scene that we shot that I was involved in.
That was it was the Zoom conference or the video conference that you guys
No,
did?
this was
it person?
it's in a library. It's me trying to explain crypto to her.
Yeah, I know what you're talking about.
And one thing kind of led to another. We flew to Spain shortly after that. And,
Yeah, that conversation, I guess that in Spain was where you and her had the conversation with Richard, right?
Yeah.
How was that experience? Just kind of researching things on the sideline and then getting to have this whole conversation with the founder of it.
Yeah, it was good. I think I was nervous, obviously. We were sitting at the table. They brought him in, and then they're like, "All right, we're filming this thing." But I thought it was a good conversation. I thought we got some good points out. I thought, I think he, made some good points. And so that kind of debate, I think, is helpful. And that's part of what the film is really about, trying to tell both sides of the story. We had lunch afterwards. And so, I don't have any issues with him as a person. To me, it's more the ideas, technology, and what you can do with it. So, just to address like the elephant in the room, like the SEC case, from my understanding, it's about Richard. And, that's why, like, at this point, I'm not particularly focused on that. Like, I just want to understand, what is Hex? What's the project? What does this thing actually do?
Yeah, absolutely. That's something I've even pondered myself, was just kind of like, what can the SEC actually do to quote unquote Hex itself? And the answer is really nothing, because it's just code on a blockchain that you can interact with or not. The effects it has are a little more tangential in terms of the ability to onboard new users and like acquire a stronger network effect over time, which that dynamic, I think, is interesting and kind of speaks to the value of it in the first place, where it's like you technically can separate the man from the code, although if you're looking at it from a price perspective, which is pretty important, there is still a effect that it has, while tangentially.
Yeah, there will definitely be an impact, regardless of
well,
which way.
we've already seen it.
Yes.
Well, tell us, before I get into some of the finer detail, with like the Hex stuff. Tell us a little bit about like your professional workings with crypto, blockchain. I know you were telling me in the background you teach a college level course in it. How did your interest start in blockchain overall, and tell us about your courses in it for your students?
Yeah. So, as you mentioned in the intro, I was an economist for the Fed. I was there 2005 to 2013. When I left to join DePaul, I started teaching money in banking. And it was my students who started asking me about Bitcoin. So that really like started me on the journey. And there's some amazing people here in Chicago in the crypto community. And so I would bring in a ton of guest speakers. There's a guy, Jonathan Solomon, who was one of the first ones, and he had like a Bitcoin meetup, and he figured out a way for people to pay him in Bitcoin at a local bar. And it was just kind of trying to demonstrate how this could be used. And so then it was kind of over the next few years, just kind of learning little by little. And 2017 is the year that I read the Bitcoin white paper. I spoke, actually, somebody in the Mexican community, a guy named Dan, was at that event. It was a Milwaukee blockchain conference where I spoke about Bitcoin. And so that was really when I got serious. And then I think it was 2020, I started a graduate course on blockchain, focused on, but not on crypto, just on private blockchains, but then gradually moved more and more towards crypto. And so this last fall was when I launched my undergraduate crypto class, and I'll be teaching that one again this next month, starting in September.
Nice. And so what made you want to, make crypto and blockchain technology part of your professional career, especially as a finance and economics guy? Because I know, especially in the early days of Bitcoin, and even now to a large degree, there's like this barrier for people in the traditional finance world to understand, like, why would people use this as an investment vehicle? What's the value in it overall? And there's a lot of dismissal towards it. But you've kind of taken the opposite direction, where you're incorporating it into your professional life, which is, financial in its nature.
Yeah, that's a great question. There are plenty of people in traditional finance, especially big names, who are very anti-crypto. They think the whole ecosystem is a Ponzi scheme. I mean, like Warren Buffett, I think, has called it rat poison squared. Bill Gates, even Jamie Dimon at times, CEO of JP Morgan, he kind of flip-flops some. But yeah, I consider myself also a bit of a technologist. So I'm also like always trying to understand how things are changing. So my background is banking, but if you think about how much even traditional banking has changed over the years, as we've gone from physical cash to then these check pieces of paper and check cashing and check clearing, to then the credit card network, to ATMs, and now mobile banking. Like there's been crazy changes even within TradFi.
Yeah.
And, that's often referred to as fintech for financial technology. And I sometimes use the phrase that I think blockchain and crypto are like fintech 2.0. This is like the next wave of innovation. And I think when I really, like, if somebody wants to say, like, when did you fall down the rabbit hole or drink the Kool-Aid? I think it was when I really started to understand Ethereum, smart contracts, decentralized applications, in particular decentralized finance or DeFi. Once I understood that you could build financial applications on a blockchain that could provide TradFi services like trading, lending, deposit taking, it's like, whoa, like this is basically building this parallel universe. And so I find it fascinating.
And did like the censorship resistance or like the trustlessness aspect of rebuilding these financial instruments and markets, did that kind of play a role into your view of it? Or was it mostly just the fact that it's like sequestered rebuilding of the things that we already have?
Yeah, no, I think, well, first of all, like I often say that I view blockchain as like a shared database, like the distributed ledger. And so this, being able to transfer value on the internet, like if we're going to like live in the internet age and have a digital economy, it makes sense that we would have this shared record keeping system. So I think that the blockchain is kind of very kind of clear as the next innovation. But then with crypto, a lot of people in TradFi, they'll say, blockchain good, Bitcoin bad. They want to kind of drive a wedge between the two. But, that question about censorship resistance, that is an interesting kind of experience I've had interacting with the Hexagon community these last few weeks. I mean, there's some people who have very strong views that like, I would kind of describe as almost political, and 100%. Political economy is a field. So like politics and economics, where those intersect, that's political economy, and censorship resistance is a good example of that. And I asked this question about know your customer, and I think just a lot of concerns around privacy and government overreach, and I think those are all fair and legitimate points. And so I would say like one of the clearest examples of this debate right now is around central bank digital currencies. And so as a former Fed economist, following their work on a digital dollar and when that's going to potentially come out, it's just a matter of time. But that has now become a political football where, like the state of Florida is saying, we're not going to accept CBDCs because that's centralized government. Like they're not even pro crypto. They're just against Washington controlling money. And the state of Texas saying, we're going to issue our own state currency. And so, I view this as kind of a classic debate in American history of centralization versus decentralization. What's interesting, like a lot of people think the Fed is centralized, and it is, but when the Fed was created in 1913, a little over 100 years ago, there was this tension between, do we want to have fully centralized power or do we want to have more local power? And so the Federal Reserve System has Washington, D.C., the Board of Governors, but then there are the 12 reserve banks around the country. And those were created as a counterbalance to the centralized power in Washington. And so when monetary policy is decided by the Federal Open Market Committee, the FOMC, the voting members aren't just the governors in Washington, it's also the presidents around the country. And they are there to represent their local interests to offset the national interests. So I just think this is part of our American ethos, and I think it's a healthy tension.
Yeah, I mean that's a pretty similar structure to the governmental system generally, with like the state governments and the
exactly
and the federal government with Congress, House of Representatives, and the dichotomy, but the relationship with them and the executive branch is like you see that bifurcation or distribution of power throughout all of the American systems to represent both the group as a whole, but also individual local groups at the same time.
Yes.
And it's that tension that has been at the heart of the American narrative from the very beginning, and in a very real sense.
Yes. Yeah. And I know there's people in the crypto community that worry that that narrative has shifted too far towards centralization. And I think that's, there's certainly arguments to be made for that. And I do I think part of why I resonate with blockchain isn't just the financial stuff. It is an element of the democratization of finance, the whole idea of I view centralized finance as hierarchical, whereas decentralized finance is more of a flat org chart. Like the Bitcoin white paper, when it says one CPU, one vote, it really is democratic money. The miners, it is a voting mechanism to verify transactions. And so there are certainly political analogies.
Yeah. And that's a concept that I've personally been exploring just in my own head. I've kind of gotten a little bit of it on paper, trying to outline some coursework on my own. But there is this interesting balance in crypto between centralization and decentralization, particularly when you're looking at both security, like network security, and then also from a price appreciation standpoint, which some people would argue the main reason why crypto has gotten so large and in the forefront of the public consciousness is not because of the decentralization innovation that comes along with it, but because of the price appreciation that the assets have undergone over time. That's where the attention has come from. And then there's this flipping of correlation, causation, or a misappropriation of what caused that. Where people say decentralization is the reason why the price has gone up, but that's not necessarily the case when you look things that are more centralized. When assets that are more centralized have a better probability of going up in the first place.
Yes.
So that dynamic between creating these new assets, where in order to gain that network effect, you kind of need this price appreciation up front in the first place. And the best way to do that is through financial centralization. But at the same time, if you lose that underlying principle of decentralization in the first place, you kind of undermine your entire argument trying to present yourself to the public in the first place. And so that tension right there, I haven't worked through it completely, but it's been it's something that I've been working through personally.
Yeah, no, I think that's well said. And I think it is, a healthy tension. I think there's some folks in the crypto community who are just anti-TradFi. And, I'm not saying TradFi is better than DeFi, but it's what we have. And I think it will continue to have a role. And so I spent a lot of time with traditional finance in financial institutions, and I talk to them about crypto, and I explain look, there's centralized finance and decentralized finance, and they're almost being built in this parallel function. I think they have an opportunity to figure out how do we operate at that intersection so that we can help connect people and bridge people across these two systems. So they need to pivot, otherwise they're going to be disrupted. And I think many of them are trying to figure that out, which is a good thing. And then lastly, your point about prices, that's one thing. That's why part of why I teach this crypto class at DePaul is especially for 20 somethings, when crypto is just price dynamics. Yeah. And it's about, trying to ride the next pump, or, oh, we got to double top. So now it just comes back into all this technical analysis, which is, it's been around in the stock market for a very long time. But then you're not talking about what's behind it. You're just talking about prices. Yeah. And so I just think that's kind of sad because, to your point, sometimes that actually is a distraction from what's really going on.
Yeah. The place where I've kind of landed and all that, and I'll say this before we kind of transition into Hex a little bit. But the place where I've landed on that with this conversation of decentralization versus centralization, or the price appreciation covering or overshadowing the baseline principles, is that it's that decentralized, trustless quality of crypto has allowed for pure market dynamics to manifest themselves on price charts, where you don't have like regulation and or heavy money being able to manipulate the price chart and or muting large absolute numbers of people entering or exiting a specific asset, right? So like, because it's decentralized, anybody can come in and anybody can leave with any amount of volume independent of what anybody says. And the only factor that dictates the velocity of that is the liquidity that exists, which is one of the powerful reasons, one of the big reasons why decentralized exchanges is a big innovation, in my opinion, is because the community can provide liquidity to set the context for the price movement in the first place. But that's kind of like where I've landed in all of this for this conversation.
Yeah.
That makes sense.
One quick comment on that, because a lot of TradFi people will say, like, well, what determines the price of crypto? I say it's supply and demand. Just like you said, it's like that old Econ 101 chart. Like, you got the supply curve and the demand curve where they meet. That's the equilibrium price. Some people hate that, but I'm like, that's capitalism. That's what a financial market is. And it's like, you don't like capitalism?
What are you, a communist? No, that's 100%. And I've done a lot of discussion about liquidity providing. And the fundamental concept that when I teach when I teach about liquidity providing, the first concept that I teach is price is simply a function of the ratio of two assets that exist within a liquidity pool. How much can you exchange one asset for the other, and what rate can you do that? And that is it. It has nothing to do with the value of the two things that are being traded. It has nothing to do with anything going on from a macro perspective. The only thing that matters is that ratio in a liquidity pool and the thickness of that ratio to allow you to move between assets, right? And it's like you're kind of stripped. You've stripped all of this, I'll just say fluff, for a lack of a better term, fluff from general understandings or presuppositions of what financial instruments are, and getting down to the base of what the quote unquote price tag or the value is. And I think that's a really interesting, it's one of the biggest mind shifts that I've had as somebody who's not a financial person. I don't know if I told you this, but like, I'm a dental student. So my background is more in science and biology. But like, it's really changed my perspective on investing, finance, and markets as a whole, just like understanding this cryptocurrency market from that foundational standpoint.
Yeah, I think when crypto first came on the scene, most people thought of it as the disintermediation of banks, but it's really like the disintermediation of any financial intermediary, including like exchanges. And so like, that's what a DEX is. It's like the disintermediation of a centralized exchange. And so now it's like the liquidity, and the trade book, it's just code. It's just an algorithmic market maker. And so now we don't have all these humans running around in these like pits. Like here in Chicago, when I first moved here, I went to the Chicago Board of Trade, and there were just like hundreds of people, yelling at each other with these hand signals. And just like, that's less than 10 years. Like, that is all gone. Like, the Board of Trade is now like a ghost town because it all went online. It's all just, And so like, it's just with technology and data and, it's continually moving more in that direction.
Yeah, I bet that's been interesting to observe from your perspective on the professional side of things, to see the digitization of money, both in a centralized sense, but also in a decentralized sense. And it seems like you're sitting in the middle of those two worlds, which is an interesting vantage point, I'm sure.
Yes. Yeah, I like to think of myself as being in that position. And I think I annoy people on both sides because they want me to be either or. And I'm like, no, I find both interesting.
Yeah. Oh, that's awesome. Well, I want to pivot a little bit into Hex, because I think we've set a really good context to start exploring kind of where your head is at right now in terms of like the value proposition of Hex.
Yeah. So this is, I think, it's a good question because, I think people, the community folks on Twitter have kind of been scratching their heads, like, what's going on with this dude? And I do want to be clear, like, I'm an academic. This is just a learning journey for me. And I like to think of myself as being open-minded and honest with that learning journey. And so, I've tried to ask hard questions, but the thing that I think has started to, make sense to me as on this learning journey is really like, why do stakers earn yield?
Mm-hmm.
Like that was the thing that was like a total hang up for me, is like, dude, if you have a smart contract that just prints money to certain people and you call that yield, like, with a lot of other DeFi protocols, like I'm earning yield because I'm lending my money, not because I'm burning it. And so like that concept just made no sense to me. And so I just think the community has been helpful to put together these pieces of why is locking up supply a service to others. And so I'm now starting to, I think a Ponzi scheme is basically a marketing strategy. You're trying to kind of pull in more new money to pay out the old money. And so you got to keep that hamster wheel going faster and faster. But a true market is an exchange of value across two parties. And so if you think about the like stakers and the liquid holders, they have different incentives and different payoffs. And so the stakers, by locking up their supply, they're removing that sell pressure. They're basically selling their right to sell their hex. They are like giving that up, which is a benefit to others because now they don't have to worry about that downward sell pressure. And the yield is like payment for that service. And so, that's been helpful. I think I can now kind of understand, like, okay, well, yeah, that is a form of service and payment.
Yeah, absolutely. And I think because I've seen you untangle that part of the hex conversation on Twitter, and I'm really glad you've gone down that road personally, because that's where I find value in hex myself, where it's this inflation model. So it's actually the perfect kind of intersection between the conversation we were having previously, where it's like there's this element of decentralization and trustlessness, but also this element of price appreciation that matters at the same time. And what the hex inflation model is, based on my understanding, is an incentivization structure that promotes behaviors that puts the context in a price positive manner, or that sets a context that pushes things towards a price positive manner, where it's like what's the word I'm looking for? You give out inflation to people who have verifiably done an action that is price positive. They've purchased the coins. They had to have gotten it somewhere, and then they've locked it up. So they've given up their ability to sell. And for that, they are rewarded through new coins being minted out of thin air. And then what that does is it presumably increases the price, which is the value to the non-stakers, because they are able to take advantage of that price appreciation over time. But having the baseline incentive structure be in a way that promotes price positivity is what piqued my interest in it. And then the fact that the unit of account is deflationary over time, where it becomes harder and harder and harder to obtain the same percent of inflation over time, it just kind of amplifies that whole reward system in the first place. And you retweeted a video from Alex, the Hedron creator, that I think he probably had put this most elegantly, where like the main innovation of Hex is divorcing the inflation from network security and placing it on price positive behavior.
That was just earlier today, and I did find that video very helpful. And I think what was like kind of eye-opening for me and starting to put those concepts together is I've when I talk to traditional finance audiences, typically the conversation's focused on Bitcoin because that's the most, it's the biggest one, most well-known. And a lot of that people often raise this question about mining and what is it? And a lot of people are very concerned about the environmental impact and things like that. But, when I try and explain that they are, verifying transactions on the blockchain and they're getting paid in new Bitcoin as compensation for that service, like, okay, people can start to like understand that. And so then to like layer onto that this idea of like, oh, well, like staking is locking up value, which is providing service to the liquid holders, and then the stakers, are compensated for that with this additional yield.
Mm-hmm.
It really like kind of like broadened my perspective of like users, whether they're miners or stakers or others, like
Mm-hmm.
you're participating in a network to the
Yeah.
degree that you are contributing to that network, whether it's in terms of security or value stability, like you should be compensated for that. And so,
Mm-hmm.
that's where the, minting your own reward kind of makes sense as a category that applies to all those things.
Absolutely. And I think, you know, a lot of times I see there are, to get down to Hex, there are basically two steps you have to jump through. First, you have to just accept the value of cryptocurrency generally. So it's like what you said, you have to accept that providing a service by validating blocks and securing the network does give value to the unit of account that's used to transact on that public ledger. Like that's I think a jump that you have to make from the value of a stock or an asset being tied to, say, cash flow or any number price to earnings ratio, any number of metrics that are used to value a company from a fundamentals perspective, and then pretty much divorce all of that and just have it as a ratio of price of supply and demand. And then where most people in crypto have the trouble jumping to something like Hex is that they find that there is only value in securing the network. Just inflating something with a smart contract doesn't have any value. Yet, at least for me, I don't want to speak for you, incentivizing people to do price positive behaviors or price stabilizing behaviors and then giving out inflation to those people is also a valid use case and does confer value, in my personal opinion.
Yes. Yeah, I think so. I agree with all that. I think the one way that I would say it slightly differently from my
Mm-hmm.
perspective is I think like the phrase price positive behavior, I think can
Mm-hmm.
scare some people off.
Yeah.
Because that sounds like, oh, well, like you're incentivizing people to pump the price, multi-level marketing also does that and things like
Mm-hmm.
that. And so that can trigger some of those kind of like, ooh, like, I don't know if I like that. That's
Mm-hmm.
why, I know some folks on Twitter can get frustrated with me of like when I'm trying to like use these other TradFi
Mm-hmm.
labels like, options, futures, zero coupon bonds. And like, how do we
Yeah.
characterize this in the TradFi sense? But A, that's kind of how I learn. And B, I think, I'm not saying any of these are the same, but if we understand how they're similar and then how Hex is different, that
Mm-hmm.
difference is then kind of what makes it unique. That makes
Mm-hmm.
sense? It's like, oh, well, it's like common in this way, but it's special in this other way. And so that helps me untangle that.
Mm-hmm.
But I kind of like this option language. I'm not saying that it's a call option or a put option, but I do think of it as a form of risk transfer.
Yeah.
Like this staker, by giving up the option to sell, they are taking on the risk that they're going to be locked up even as prices are falling and they're unable to sell in that type
Mm-hmm.
of market. And so, it's just one of the things I can't stop thinking about is like, well, the stock market, you have call options and put options, but those are like options that you are giving to somebody else. Like
Mm-hmm.
I'm selling you an option, you're paying for it because now you have more optionality.
Mm-hmm.
With staking, you are giving up an option. And I'm just
Mm-hmm.
like still trying to process that. But I think then it's not like, oh, I'm pumping the price. And so, yay, like good for me. It's like, no, like I'm giving up something of value, which is my choice. And
Mm-hmm.
therefore you're paying me to give up that choice.
Yeah. Yeah. Well, real quick, I want to take a quick break, not break, but a quick segue just from this Hex Whale. Lamont Orange is live. Love to see it. I also have seen that you've delved into Pulse Chain meme coin, sir. That your favorite drink, I guess, is orange juice, right?
Oh, man. I think I got a little carried away that day.
Hey, the memes will suck you in, and you know what? That's part of the fun, in my opinion. If you're not here and you're not having some fun, like what a
Yeah,
big
you do.
deal.
Like when you're
Yeah.
talking about difficult stuff, you got to keep
So
it
yeah.
lighthearted.
Yeah. So Hexwellbot, thank you for both the $5 and $10 super chat, dude. I'm gonna go buy some orange juice with the pulp and a little bit of tang as well, just to celebrate that. I appreciate it, man. But yeah, I think that. So well, let me not push back, but let me offer a little attention because you brought up a more semantic point. I think with like tangential substance, where you're trying to understand these things from the TradFi perspective with things that you understand, and that's how we best under things. Comparing it to what we understand, finding the difference, and then we understand that thing a little bit better because we have reference points in order to view it from. It's kind of like concordance in a lot of ways. But does my description of like the incentivization structure of Hex promoting price positive behaviors, is that literally wrong or like technically wrong, or is it more a semantic point that you have with it?
Yeah, that's a great question. So my response was more to the semantics.
And let me say, I have no problem with semantic arguments because if we're
yeah.
talking about obtaining network effects, that is important.
Yes, for sure.
Yeah.
Right. You always have to be thinking about how do outsiders hear me, not just how do I hear myself, right? I am kind of trying to work through your question of the technicals because I think there's kind of two different dynamics. So like when a person stakes, they're giving up the right to sell, which removes downward price pressure if they were to sell. So they're basically it's providing information to the market that this person can no longer sell. Therefore, from like a probability standpoint, if you think about a probability distribution, it's removing some of that bottom of the probability distribution, right? Does that make sense? So that if you then think about the expected price would be higher because now the probability distribution has shifted higher. So I think that is a benefit. So I would agree with you there. It does support price in that way. But then, part of what I think I'm still trying to work through is the inflation and how the staking relates to the rate of inflation. And this is, we probably won't have time to get into this today, but there does seem to be a little bit of uncertainty even within the community of like, well, is the rate of inflation fixed? And then T-shares just determine how it's allocated? Or is the actual rate of inflation variable and capped? Like I think, what is it, 3.69%? Like that's a cap. That's not like fixed. Those are cap and fixed are two different things. And so trying to kind of process that a little bit because there were some charts saying that, showing that real actual inflation is below that number. So, and then to wrap up that point, so to the extent that staking increases the rate of inflation, that also increases the rate of dilution to the existing owners. And so, the more I stake, the more I grow my yield. On the back end, I'm putting more supply on the market. And so it's really not about the total number, it's about the dynamic. I'm removing supply on the front end of the stake, and I'm adding supply on the back end of the stake.
Yeah, that temporal sense of when that raising of price dynamics going more in the upwards direction from that probability distribution you're describing is more in the immediate sense, and then in the later sense, when the inflation actually hits the market, then that dynamic changes.
Right. So when you talk about this is good for price or price positive, you have to think about that back end too, because that's a little bit less clear.
Yeah, and that brings up an interesting point because the price appreciation, let's just assume that any price appreciation is as a result of this inflation dynamic of Hex, where it's like, does it matter if that price appreciation only came about because of a temporary shoring up of supply in the first place? Another way of saying that I'm trying to get at is like, if something is printed on the chart, that kind of cements it into reality in the first place from a psychological standpoint. So like as price goes up, people's internal understanding and valuation of the asset starts to change with the dynamic pricing within the market, or at least I've experienced this myself with the volatility in cryptocurrency as a whole. And then the question is, does that change in psychology of market participants translate into different behaviors later when the inflation comes out? I'm not sure that made sense. I don't know if
Yeah,
you
no,
follow me at all.
that did. Yeah, one quick side note as it
Yeah.
relates to the field of finance.
Mhm.
I think the field of finance has become much more open, not even within crypto, just in general, much more open to the role of human psychology.
Mhm.
Like so, like when I was in grad school, it was all efficient market hypothesis. Every
Mhm.
agent is rational. They're all making rational decisions based on the
Mhm.
information they're given. And then the financial market, incorporates all that information into this rational outcome. And I
Yeah.
think during the financial crisis of '08 and '09, people really started to think about bubbles and this idea of like people hurting, kind of following the trend up and
Mhm.
then following it down. That's typically referred to as behavioral finance. So I
Mhm.
think your argument, your question would be very much in that behavioral finance field, which
Yeah.
is legitimate. But again, the reason I hesitate is there's also been discussions online of like the blockchain data and the analytics. Like you can see how much has been staked, what the maturity
Mhm.
is staked. You can see when it's going to unstake. And so, even if you're like glad that, oh, look at all these people staking, that's like helping me out today, then you think about, wait a second, what about all that dilution that's coming down the road? Like as a
Yeah.
rational person, you should be thinking about that.
Yeah, and I would say the community has to a large degree. I mean, we have all of those charts available
Yes.
publicly, and one strategy that people have had is planning your stakes to end before these really big stakes end, because the probability of people taking profits and the price decreasing within that period of time is pretty high.
Yeah.
Yeah, um, yeah. As I was saying, what I was saying, I didn't like it as much. I'd have to think through it more. But I guess the idea that I was trying to get across is like, to put it crudely, can you facilitate an artificial bubble in the short term so violent enough that it cements the asset as legitimate over time to a degree that it outweighs uh, the dilution in the future? I don't know. That's it's a little
So
shaky, but
yes, you might be right. That might be
mhm.
possible, but the thought of it kind of makes me
Yeah,
nauseous
yeah,
because it's
yeah,
like, are
yeah,
we just because that sounds like maybe it's not pump and dump, but it's pump and
mhm,
hold. And it's
yeah,
like, if that's what so many people associate with Hex, it's like just trying to pump it up, pump it up. Come on,
yeah,
we got to onboard, get your friends, get your neighbors, and
yeah.
let's get out there and do some outrage marketing. It's going to work. And it's like,
Mhm.
if that's the narrative, I think
Mhm.
people are just like, ee.
Yeah, I know. I don't personally. Oh, let me see if I can get this to fix itself in a second. Yeah, that's fine. When I think about that, it doesn't feel like the whole picture exactly what I'm saying across, because I'm like, yeah, that doesn't sound like the most sound thing to base, say, like a monetary policy off of. But yeah.
But so one comment to support your thought, which again is from TradFi.
Mhm.
So in traditional monetary policy, like the Fed,
Mhm.
their job is to manage inflation,
Mhm.
and they're not just managing actual inflation, they're managing inflation expectations.
Mhm.
And they're trying to anchor those expectations, and they're trying to keep prices from rising too much. They want to
Mhm.
anchor them lower. But, kind of the flip side of that from your perspective is like, how do we anchor expectations in terms of crypto prices higher so
Mhm.
that current behavior is based on expectations of future prices?
Yeah.
Yeah, there's an argument to be made there.
Yeah, another thing that comes to mind in this discussion is that the deflation of the T-share rate, where so if the people who are getting that inflation that dilutes the market value based on the sell pressure, if they sell, their ability to get that same amount of inflation going in the future, well, one, it becomes harder for them to get it with the same number of coins. That's kind of how the system is programmed. But also, when they're giving that up, they give away that inflation, that ability to reclaim their stake in the system, that much more difficult. And if we just assume there's some demand of not just demand for the coin, but demand to get inflation going on in the future, it's become that much more harder, proportional to, I guess, probably exponentially relative to the timeline of that stake based on the T-share rate increasing. So the new people who are acquiring the coin because they want to delay gratification or be in the same position that the current end stakers are, but later on in the future, their ability to get a similar proportion of the inflation is harder. So then it requires more supply to be locked up in order to get yourself in the same position later on in the future. That feels like a better explanation of alignment of incentives for why it could theoretically continue to perpetuate.
Yes. Yeah, I do. I think incentive alignment is a good phrase, and I think that makes sense. And that that rising T-share, like in economics and finance, we often say monotonic when something is just constantly rising, like the T-share price. When I started thinking of, like, there was one post I had of, like, basically that is a continually falling interest rate environment.
Yeah.
Which, I actually, if you think about, like, if you stake early, you get a higher yield than if you stake later. That's like high interest rate. Now, each day it's a little bit lower, a little bit lower, a little bit lower. And then just thinking about the, like, hexonomy and what does that mean that we have this continually falling interest rate? And, it's just so different than thinking about, like, an interest rate cycle in fiat.
Yeah. And then, unfortunately, I know you have to leave in a couple minutes, and I wanted to get to Hedron really badly with you, but I feel like we've gone down a really good rabbit hole here.
Yes.
I want to, for the last couple minutes, just keep going down with the line of thought that we have. There's another element to this, and that is you have the yield that you get from hex inflation. But at the very least, if we assume that it has some kind of market value and market participants, there is also a yield element from a liquidity provider's perspective, where the service you're providing from that perspective is allowing other people to trade with your coins. And so the people who get a large percentage of the inflation going into the future get a large percentage of the fees that are accrued based on market cap activity. Sorry, that's a long way of saying volume, of the volume in the market. They get a larger percentage of those fees. And to a larger degree, they get a lot of power in the system, because the degree of liquidity directly correlates with the degree of volatility in the system. So this is what my actual personal thesis in crypto, where the biggest goal, or the ultimate goal, the ultimate end game for crypto, is to accumulate a bag that accrues in value so highly, like the valuation of that bag so high that you can't actually exit with the liquidity that exists, but you're able to capitalize on that high valuation of assets through yielding protocols, like through liquidity providing, by allowing other people to trade with your tokens and then getting a percent of the fees that are associated with those trades. So you're getting passive income, or a form of income based on inflated valuations, but 5% of 1,000 is much different than 5% of 1,000,000. And so if I'm able to yield on 5% of, let's just say, a 9-figure bag, and that amount of fees that I'm receiving is able to be exited through the liquidity that exists, that I'm in part actually providing the service for to create, then that's a really powerful place to be from a financial place, but also from, like, a market maker's perspective as well.
Yes.
And the people who delay their gratification that long and get that supply may be incentivized enough to use some of that liquidity in these other fashions, because it provides them with in the hex community, like I say, a golden goose to a large perspective.
Yes. Yeah. One of the terms that it would probably be good to put out there and see how people react is just, I'm still trying to process how the community views the word liquidity, and whether, like, is liquidity a good thing or a bad thing? This came up actually in one of my segments with Richard in the movie. I don't think it made the final cut, but he was arguing that, like, liquidity is a bad thing because that allows people to sell. And, like, in the world of, like, finance that I come from, like, liquidity is a good thing. And it's just, it was like such, like, whoa, like, we could not think about this concept any more different. So, that would be fun to put that out there.
Yeah. Well, I know we've hit the time. I know you have to head out. So Dr. Black, I really appreciate your time. I know we didn't get to everything that we wanted to talk today, so I'd love to invite you on again if you happen to have more time to continue the conversation and maybe dive a little bit into Hedron and ICOSA as well, because I think we could have I think I would enjoy that conversation personally. So if you want to come just to appease me, to have a good conversation, I would really appreciate it. And I'm sure the people in the audience would appreciate that too.
Sounds good. Thank you, CryptoSloth.
Of course. Hey, thanks for coming on. I appreciate you coming on my channel, being so open and receptive to the community. I appreciate it, and I know I speak for a lot of people where we all appreciate it too. So thank you so much.
All right. Thanks. Take care.
All right. Take care. Yeah. All right, guys. That was a really great stream. I'm going to go ahead and hop off. I hope you guys enjoyed it, and I'll see you guys later. Peace.